Something just happened in the silver market that most investors will not find out about until it's too late. A deadline has been set, not a rumor, not speculation. A structural shift in how silver is priced, allocated, and controlled. And the clock is already ticking. If you hold silver, if you're thinking about silver, or if you've ever wondered why this metal keeps getting suppressed while everything around it explodes in price, you need to watch this video from start to finish, because what I'm about to show you changes the math entirely. Stay with me, because in the next 20 minutes, you're going to understand something that most retail investors, most financial advisors, and most mainstream commentators are completely ignoring right now. We're going to talk about the silver fix, what it is, who controls it, why it's broken, and why a deadline now exists that could force a repricing event unlike anything silver has seen in modern history. By the end of this video, you'll understand why some of the most sophisticated commodity analysts on the planet are quietly positioning themselves before the rest of the world catches up. Most people see silver as a shiny metal you buy when you're scared. Smart money sees something completely different. Let's begin. What is the silver fix, and why does it matter? To understand what's happening right now, you need to go back, way back, to 1897. That's when a small group of London banks began meeting, literally sitting in a room together, to set the global price of silver. They called it the silver fix. And for over a century, that's exactly what it was. A fixed price, decided by a handful of institutions, behind closed doors. Now here's where it gets interesting. In 2014, the London Silver Market Fixing Limited, the entity that ran this process, collapsed under a storm of manipulation allegations. Major banks were accused of coordinating prices, front-running trades, and exploiting a system that gave them information no one else had. The old fix died. But did the manipulation? A new mechanism was introduced, the LBMA silver price, run through an electronic auction process. More transparent, they said. More fair, they said. But here's what the financial press largely missed. The underlying structure, the paper silver market, the synthetic positions, the leverage, none of that changed. The name changed, the faces changed. The game stayed exactly the same. And now, that new system is under pressure. Serious pressure. The leverage problem. Let me give you a number that should stop you cold. For every 1 ounce of physical silver that exists in allocated, deliverable form, there are estimates suggesting anywhere from 100 to 300 paper silver contracts floating in the market. Read that again. 1 ounce, up to 300 claims on that ounce. This is the fundamental architecture of the modern commodities market. It works until it doesn't. It functions until enough people ask for delivery, and right now, something is changing in who is asking. Industrial demand for silver has entered a phase that analysts are describing as structural, not cyclical. Solar panels, electric vehicles, defense electronics, AI server infrastructure, medical devices, all of them require silver. All of them are growing. None of them are slowing down. The Silver Institute reported that industrial demand has hit record levels in recent years, and the projections forward are not modest. They are aggressive. So you have a paper market built for a world where silver was primarily a monetary and jewelry metal, now being strained by an industrial reality it was never designed to handle. The pressure is building, and here's the part most people don't talk about. When industrial users need silver, they don't buy futures contracts. They need the physical metal. They need it in their supply chains. They need it now. And if the paper price doesn't reflect the real physical market, eventually something snaps. The deadline. Now let's talk about the deadline, because this is why you're here. The LBMA, the London Bullion Market Association, and various regulatory bodies have been under increasing scrutiny to reform how precious metals are priced and settled. The pressure has come from multiple directions. Institutional investors who lost money in suspicious price movements, industrial users who believe they're being systematically disadvantaged, regulators in multiple jurisdictions who watched the 2014 scandal and quietly noted, this is not over. What has emerged from this pressure is a series of reform requirements. Structural changes to how silver positions must be reported, how delivery obligations must be honored and critically, how leveraged paper positions must eventually reconcile with physical reality. Think of it like a margin call, but for an entire market. If you hold a leveraged position, and suddenly the rules require you to either deliver or unwind, you have a deadline. And when hundreds of institutions face that deadline simultaneously, the math becomes very uncomfortable. Here's what historically happens in these moments. Traders who are short silver, who have sold silver they don't have, betting the price stays low, suddenly need to buy, all of them, at the same time. Supply doesn't magically increase. Miners can't double output overnight. Recycling can't fill the gap. But demand is already here. Industrial demand, investment demand, central bank diversification demand, all of it converging. If these conditions continue to develop, as the data currently suggests, the math begins pointing toward a repricing that would make the 2011 silver surge look like a warm-up. The macro backdrop. Now let's zoom out. Because silver doesn't exist in a vacuum. It exists inside one of the most complex and dangerous macroeconomic environments in modern history. Global debt is at levels that would have seemed fictional 20 years ago. The United States alone carries a national debt that surpasses the combined GDP of every nation in Europe. And the interest payments on that debt, not the debt itself, just the interest, are now one of the largest line items in the federal budget. This matters for silver because of what governments do when debt becomes unmanageable. They inflate. They debase the currency, slowly at first, then faster. They create money to pay obligations they can't fund through taxes. And every dollar, euro, or yen they create silently steals purchasing power from every dollar, euro, or yen you already hold. Gold knows this. That's why gold has been making historic highs. But silver is different. Silver is gold's more volatile, more industrial, more explosive cousin. And historically, when gold moves, silver follows. Not at the same pace. But when silver catches up, it catches up violently. Look at the gold to silver ratio right now. Historically, the ratio is averaged somewhere between 15:1 and 41, meaning it takes 15 to 40 ounces of silver to buy 1 ounce of gold. At certain points in history, when monetary systems reset, that ratio has compressed dramatically. As of recent trading, that ratio has been sitting in ranges that historically preceded some of the most significant silver repricing events ever recorded. Smart money doesn't ignore the ratio. Smart money tracks it obsessively. Who is buying and who isn't telling you? Here's something the financial media rarely discusses clearly. Central banks have been buying gold at record levels. That part makes the news. What gets less coverage is the movement in physical silver among sovereign wealth funds, industrial reserve programs, and large family offices. These are not retail investors chasing headlines. These are entities with multi-decade investment horizons that are quietly building physical silver exposure while the mainstream conversation is still debating interest rates. Why physical? Because in a world where financial counterparty risk is rising, where banks have failed, where currency swaps are being renegotiated, where the SWIFT system is being challenged by alternative payment rails, owning a physical asset with no counterparty liability becomes a different kind of insurance. Gold does this, silver does it too. But silver also has the industrial demand floor underneath it, a floor that doesn't exist for gold in the same way. You combine monetary demand with industrial demand with a structurally broken pricing mechanism under reform pressure, and you start to understand why the people who understand this best are not talking about it loudly. The quieter the smart money is, the more serious the position. The mining reality. One more piece of this puzzle that most investors completely miss. Silver is not mined the way people think. Roughly 70 to 75% of all silver produced globally is extracted as a byproduct of mining other metals: copper, lead, zinc. Primary silver mines represent a minority of total supply. This matters enormously because it means silver supply is not primarily responsive to the silver price. If silver doubles, primary silver miners benefit. But the copper mines, the zinc mines, the lead mines, they're not making production decisions based on silver. They're making them based on their primary metal. So when demand surges, and industrial demand is surging, the supply response is structurally limited. You can't simply build more silver mines. The silver isn't there in primary deposits at the scale required. And here's the other side of this. Existing silver deposits are being depleted. Average ore grades and the concentration of silver in the rock being mined have been declining for decades. You have to process more rock to get the same amount of silver. That means higher costs, more energy, more time. The supply ceiling is lower than most people think. The demand floor is higher than most people understand. And the paper market, sitting between those two realities, is under deadline pressure to reconcile with physics. Physics always wins. The question you need to sit with. Let me leave you with this. Every major monetary repricing in history, every moment when a suppressed, misunderstood, or structurally manipulated asset finally broke free of the mechanism holding it down, was followed by the same reaction from most investors. I knew it was coming. I just didn't act in time. The silver fix deadline is not a conspiracy theory. The leverage imbalance is not speculation. The industrial demand surge is not a rumor. The macroeconomic conditions accelerating monetary demand are not invisible. They're in the headlines every single day, hiding in plain sight. The question isn't whether the silver market has a structural problem. The question is, when the structure finally moves, will you have already positioned yourself, or will you be explaining to yourself why you saw it coming and did nothing? I'm not telling you what to do with your money. That's not what this channel is for. What I am telling you is this. The deadline has been set. The clock is running. And the people who are going to benefit most from what comes next are not the ones who find out about it after it happens. They're the ones watching videos like this one, right now, while most of the world is still looking somewhere else. Stay informed, stay ahead, and I'll see you in the next one.